Thank you for tuning in to another edition of the Vulcan Report. All right, the purpose of this video is to discuss some methodologies in how to place your stops and trail stops so that you can move with the market when you're trading the pulse waves. Okay. Now, there is really no hard and fast rules to trailing positions. Basically, we teach that you should take what you can and give nothing back. Alright, so whatever you can take out of the market, whatever the market gives you, that's what you take. However, there is some method to the madness that you can use to try to lock in profits and move along with the trend. Okay, this is a chart of the Dow. This is where we left off in our last video, so we'll just use this as an example. Okay, as you can see, we had a pulse wave back on September the 2nd of 2010. Alright, the market managed to close at 10,320, right? Okay, so let's assume that you were along from that high of 10,320.37. Alright, the actual pulse wave on that was 10,173, by the way. So we'll just use that one. How about that? Alright, so you're long from the pulse wave, 10,173. The market closes at 10,320. Alright, so you're already closing in the money, and your initial stop is already placed, alright, below the market. As the market continues to break out and the pulse wave begins to develop, you start to see that the market gets above the secondary support line, which is this red line right here. Okay, one method you can use to trail your stops is placing your stop right at the secondary support line. This is this red line here. Okay, for those of you in the Black Ops trading room, you'll notice that on your sheet as the support low. Okay, so you move your stop to the support low, and you do that every day. Alright, and that support low is designed to keep you in the trade to move with the market. As the market moves up, you see the red line moves up with the market, and that's where your stop is. Okay, it's giving the market room for flash crashes and everything else in between, pullbacks, dips, all that stuff. Alright, spikes. It moves with the market as the market moves up. So even as you can see, as the market's moving up, for those of you in the room who trade the swing trade signals in conjunction with the pulse wave signals, you see the market's constantly giving you additional waves that form within the general wave, well, I can say the master wave. Okay, so we had another pulse wave here on September the 17th, another pulse wave here on September the 27th, another pulse wave here on September the 29th, another pulse wave here on October the 8th, another pulse wave here on October the 25th. And for those, if you missed it, you're able to get back into it and still to catch the developing waves within the main wave. And you can even, use this as an opportunity to add to your initial position. So every pulse wave you get, you add to the position. Excuse me. And you see how the red line, the support low, is keeping in tandem with the market. Okay, now if you follow the trailing stop, you see that you would have been stopped out on November the 12th. So let's look back at where we started and see where you ended up. Okay, you got filled on September the 2nd. You were long from 10,173, right? You trailed your position, so 10,173, and you would have been stopped out here. Okay, and this is, you would have been stopped out at 11,182. So basically you picked up 1,000 points in the Dow, trading the Dow futures, or we say the mini Dow futures contract. That's how you make 1,000 points trading with the pulse waves. That's how it works. It's just really that simple. Okay, so you would have been stopped out here on November the 12th, and you would have waited on the sidelines for your next pulse wave signal. Okay, The next pulse wave signal you got was a negative pulse wave, okay? And you know the rules that we teach in the Black Ops about negative pulse waves in a bull market. You got no follow through, so you're still on the sidelines waiting for your next signal. All right, you would have been about a week and a half before you got the next pulse wave. You would have been long again in the next pulse wave of 11,206. And again, you see where you have your stop at. You see the red line here. So from 11,206 is where you are now. And as you can see, the pulse wave has not moved up any higher than that. It's kind of remained flat. So your stop, you got in at 11,206, and right now your stop is at 11,260. Let's go back again. The next pulse wave was 11,206. Currently, your stop now is at 11,260. So you have locked in roughly 50 some odd points is where you are in the market right now. See how that works? You can even move it up higher if you wanted to on an intraday basis and trail it that way. Okay, if you wanted to get out now and take profit or what have you. So you do have some flexibility when you're using the system. Does that make sense? It should. All that should be sinking in about right now. Okay, so that's pretty much it. That's what I wanted to show you. It's just really that simple. When you're trailing your stops, use the support low feature in the spreadsheet, and you're good to go. All right. There's really no hard and fast rule. Sometimes we'll move a stop so tight that we'll be within ticks of the market because we want to squeeze out maximum profit because we're doing a different pattern. Those of you who are in the Black Ops room, you know what I'm talking about. When we're doing our intraday 2-bar Charlie method, it does require very tight stops as you're trying to milk as much out of the trade as possible on an intraday basis. So you can move those stops closer on an intraday basis, especially when you're adding to a pulse wave using the 2-bar Charlie method. All right. So that's pretty much it on how to set those initial stops and trail them. Remember, take what you can and give nothing back.